Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Here's what's on deck for today. First up, US mortgage rates have just plunged to a 3-year low ahead of an expected Fed cut, but a classic market paradox could send them surging right back up. We'll get into the buy the rumor, sell the news dynamic and what it means for you. Then we'll turn to trade, where the US has just slapped India with 50% tariffs over its ties to Russia. Surprise talks, however, could unlock a major friendshoring deal that reshapes global supply chains. And finally, speaking of trade friction, the US has indefinitely suspended a steel deal with the UK, leaving a 25% tariff in place and a major industry in crisis. We'll break down how this could spark protectionism and create a new headache for the Bank of England. Mortgage rates just hit a 3-year low, but they could be about to shoot higher right after the Federal Reserve announces a rate cut. It all comes down to a classic market principle. Investors don't wait for the news. They trade on the expectation of it. This is the buy the rumor, sell the news dynamic in action. Here's the setup. The average rate on a 30-year fixed mortgage just plunged to 6.13%, its lowest point since late 2022. That's a massive 12 basis point drop in a single day, as investors pile in, betting on a widely expected rate cut from the Fed. The key thing to remember here is that mortgage rates are closely tied to the yield on the 10-year US Treasury bond. When investors anticipate a Fed rate cut, they rush to buy these bonds, which pushes the bond price up and its yield down. This is the buy the rumor phase, and it's why we're seeing mortgage rates fall right now. This is where the situation takes a more complex turn. According to Matthew Graham at Mortgage News Daily, we've seen this movie before. He points back to September 2024, when a similar setup led to a shocking outcome. His words, mortgage rates moved paradoxically higher after the Fed rate cut. The same thing could happen this time. So the thing is, once the Fed actually announces the rate cut, the event everyone was betting on has happened. If the cut is exactly what was expected, or if the Fed hints that future cuts might be slow in coming, investors may decide to take their profits and sell their bonds. This is the sell the news part. A wave of selling pushes bond prices down and sends yields, and therefore mortgage rates shooting back up. For example, back in December 2024, the Fed cut rates, but because they signaled fewer cuts ahead, the 10-year Treasury yield actually jumped 12 basis points. So what's the real game being played? Willie Walker, the CEO of commercial real estate giant Walker and Dunlop, breaks down the historical trap. He notes that over the last 45 years, when the Fed cuts rates during a recession, long-term mortgage rates tend to fall. The historical context is crucial because during a recession, the Fed tends to cut rates aggressively to stimulate a weak economy. This strong signal pushes down long-term yields as investors expect a prolonged period of low growth and low interest rates. But when the Fed cuts rates in a non-recessionary environment, which is exactly the situation right now, he says it does not impact long-term rates. The key here is the difference between a crisis response and a simple adjustment. Research looking at 9 Fed easing cycles since 1980 confirms this. During recessions, Fed rate cuts averaged 2.32%, and the 10-year Treasury yield fell by a significant 72 basis points. But in non-recessionary periods, what some call a soft landing, the rate cuts were much smaller, averaging just 0.97%. And the impact on the 10-year yield? A tiny drop of only 6 basis points. That distinction explains why a rate cut today might not mean a cheaper mortgage tomorrow. Walker is expecting at least a 25 basis point cut from the Fed, maybe even 50. But he warns that even with those cuts, he doesn't expect it to move the needle on the rates that matter for your home loan. His final prediction is the one that should have everyone's attention. He thinks investors might buy on the rumor and sell on the news, and that we'll probably see the 10-year sell-off a little bit after the Fed actually announces their 25 basis point cut. And there's another powerful force at play, one that comes from outside the US. After all, US interest rates are not set in a vacuum. They are heavily influenced by global demand for US Treasury bonds. For a long time, foreign countries have been major buyers. However, if that demand weakens, for instance, if major holders like China reduce their purchases, it means there are fewer buyers for US debt. This lower demand could put upward pressure on Treasury yields, creating a higher floor for how low US rates can go, regardless of what the Fed does. This links US mortgage affordability directly to global capital flows. So what should we watch for? The key indicator will be the 10-year Treasury yields reaction immediately following the Fed's announcement. Pay close attention not just to the rate cut itself, but to the language the Fed uses about the future. Any hint of a hawkish or cautious tone could trigger the sell-off. It leaves everyone wondering, as the market braces for a rate cut, are home buyers and investors about to get caught on the wrong side of the trade? From domestic markets to global trade tensions. Now, get this. The United States just slammed a massive 50% tariff on goods from India. The reason? A direct penalty for Delhi's ongoing purchase of Russian oil and weapons. A while back, we walked through how Washington was even leaning on Europe to mirror or go further with calls for 100% tariffs on China and India and Treasury, signaling it could escalate if it secured stronger European backing. Today's move on India fits that arc. Pressure first, leverage second. This isn't just a random act, though. It's a live test of the Trump administration's trade playbook. The pattern is clear. Impose steep, disruptive tariffs first to create leverage, and then force trading partners to the negotiating table to extract concessions. We previously analysed that this approach was being exported to allies too, with US Treasury Secretary Scott Bessent saying Washington could go further if Europe got on board. The latest development is that the White House is using the first hit then talk sequence directly with Delhi to see if leverage alone can deliver movement. India has called the tariffs unfair, and the move has led to a swift and surprising deterioration in ties between the two allies. And if the actions are dramatic, the language is getting even more intense. One top US trade advisor, Peter Navarro, has gone on record referring to the war in Ukraine as Indian Prime Minister Narendra Modi's war. Continuing our last discussion about unintended consequences, this kind of pressure risks pushing China, India, and Russia closer together under the BRICS umbrella and amplifying de-dollarization efforts. We flagged that dynamic a while back. This entire conflict serves as a key signal of the administration's policy priorities. It reveals a fundamental tension. Does geopolitical alignment like pressuring India over Russia outweigh purely economic objectives such as gaining market access? The outcome here will set a precedent for how the US engages with other major non-aligned economies. And remember, as the war itself has intensified, think of some of Moscow's heaviest barrages a while back. The political incentives to harden this trade line have only grown. But just as negotiations completely stalled and a previous round of talks was called off, something shifted. A US trade team is now back in Delhi for emergency discussions. Officials on both sides are sounding more conciliatory, with Donald Trump's nominee for US ambassador to India stating a deal could be resolved in the next weeks. We previously noted Washington was testing whether allied backing in Europe would be necessary to escalate. Today's pivot to talks suggests they're seeing if the initial tariff shock created enough bilateral leverage without widening the front. The potential prize behind this sudden reversal is a concept called friendshoring. A breakthrough in this US-India trade deal could massively accelerate this strategy, which is all about diverting import demand for goods like garments and electronics away from China and toward allied nations like India. For Chinese-speaking audiences, this is a critical trend to watch. It would directly test the trade-off between higher near-term costs for US consumers and the long-term goal of building more resilient supply chains that are less reliant on China. That said, as we mentioned before, pushing this model too aggressively across the Atlantic would collide with Europe's deep dependencies on Chinese inputs from high-tech materials to pharma components. So for now, the pressure remains focused on Delhi. But that's not the whole picture. The real sticking point goes much deeper, straight into the core of India's massive protected agriculture sector, a key sticking point for years. Believe it or not, India's protectionism in this area is extreme. We're not just talking about small barriers. Research from the US Trade Representative shows that India maintains average tariffs of nearly 40% on agricultural products, with some tariffs reaching as high as 100% on things like walnuts and even 150% on alcoholic beverages. This is why it's been such a difficult issue to resolve. Washington wants greater access, but India has fiercely protected its millions of small farmers, citing national food security. The tension was captured perfectly by US Commerce Secretary Howard Lutnick, who recently repeated his criticism, asking why a country of 1.4 billion people wouldn't, quote, buy one bushel of US corn. This isn't just a discussion, it's a high-stakes negotiation where livelihoods, food security and global alliances are on the line. With both sides now back at the table amid intense pressure, the question is, will this lead to a historic breakthrough, or will one of the world's most critical partnerships fracture? We previously warned that if Europe were to mirror Washington's tariff line, the risk of a broader trade war would spike. What happens in Delhi over the next stretch will either cool that trajectory or accelerate it. The timing here is critical because a breakthrough could have immediate economic effects. If a new trade deal removes these hefty tariffs, it would provide a targeted disinflationary impulse for the prices of goods in the US. This could offer a small but welcome relief in the Federal Reserve's fight against inflation, especially if price drops are stalling elsewhere. Looking ahead, the key things to watch will be US import data specifically, whether import volumes for apparel and electronics from India rise as volumes from China fall. And alongside that, keep an eye on any renewed US push for European alignment on tariffs. Together, those signals will tell us whether friend shoring is truly taking hold or whether we're sliding toward the broader bloc dynamics we cautioned about before. Speaking of high-stakes trade disputes, the friction isn't just with India. Another key US ally is finding itself in the crosshairs over steel. A proposed deal to eliminate tariffs on UK steel exports to the US has just been put on hold indefinitely. To understand the stakes, you have to look at the global steel market, which is currently wrestling with a massive oversupply, a situation often linked to the sheer scale of production from places like China. This has created a domino effect where countries are increasingly putting up trade barriers or tariffs to shield their own domestic industries from a flood of cheaper imports. This stalled US-UK deal is a classic symptom of this growing global trend towards protectionism. That leaves a staggering 25% tariff in place, a gut punch for an industry that was promised relief with fanfare. For context, these US exports make up 9% of all UK steel exports by value. One UK producer says they are, quote, furious, now struggling to compete with a major price disadvantage against American steel. In reality, this relative advantage is not enough. The key here is the absolute cost. A 25% tariff still makes UK steel significantly more expensive than steel produced right inside the United States, which faces no such tariff. Recent data from the US Census Bureau confirms this, showing that UK steel export volumes to the US are already declining, undermining any narrative that a lower tariff alone could secure their market share. So what derailed the deal? Here's where it gets interesting. US officials are reportedly questioning the very origin of the steel, specifically whether exports from the UK's largest producer are technically made from scratch in the country after it shut down its blast furnaces. Now, this isn't just a technicality. This is about something called rules of origin. These rules are an increasingly common tool in international trade, acting as a kind of non-tariff barrier. Think of them as a product's passport, determining its economic nationality. By scrutinizing these rules more closely, a country can effectively block imports without officially raising tariffs. This is a leading indicator of rising trade friction, and it signals a potential threat that could spread beyond steel to other UK industries with complex global supply chains, like automotive and electronics. However, if you zoom out, you'll see another layer to this. This isn't just about one deal failing. The entire UK steel industry is in what's being described as considerable financial distress, with the government already taking over some Chinese-owned and Liberty Steel plants. This setback comes at a time when one committee chair warns that Britain now trades with its biggest partner on terms that are, quote, worse than the past. You see, the struggles in the steel sector are a lagging indicator of the UK's overall industrial health. This means the problems we're seeing today reflect deeper, pre-existing economic weaknesses. This continuous erosion of the UK's primary steelmaking capacity not only exposes vulnerabilities in its strategic supply chains, but also increases the fiscal risk for the government, which may be forced into costly bailouts that strain public finances. The situation prompted a dire warning from the trade body UK Steel, with its director stating, "In these market conditions, the last country to protect their industry will be the first to lose it." This is a powerful statement because it points to the immense pressure the UK now faces. The likely next step is for the UK to consider erecting its own defensive steel tariffs to protect what's left of its industry. But this move comes with its own set of problems. And this creates a dangerous feedback loop. A pivot to protectionism would mean higher steel prices within the UK. This would directly feed into the producer price index. which is a leading indicator for consumer inflation. This is a major concern right now because it would mean higher costs for major domestic industries like construction and manufacturing, creating a stagflationary headwind. This complicates the Bank of England's job, making it harder to bring down inflation without further damaging economic growth. While the government insists there remains a path to zero, the industry is now facing total uncertainty in a world where a surplus of cheap steel is causing countries to erect trade barriers to protect themselves. This leaves the UK in a precarious position, wondering if it's just been left out in the cold. Looking ahead, we should expect continued pressure on the British pound as the country's industrial outlook weakens. For investors, UK steel company stocks will likely face significant headwinds. The key thing to watch now will be policy signals from the UK's Trade Remedies Authority. Any move to introduce new tariffs will confirm this shift towards protectionism. At the same time, keep an eye on the UK's Producer Price Index, or PPI, to see if these trade disputes begin to translate into higher inflation for everyone.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.